This question is from Michelle Tuttle 4409. This question here: how can investors diversify beyond equities and bonds when you need to withdraw money during a bear market, or do you need to? 2022 proved stocks and bonds can fall together. What alternatives offer real protection now? Unfortunately, for compliance purposes, I really can't make any investment recommendations, but there is an architecture to this question that is interesting to explore and worth exploring a bit. Um, if I distill the question down to a summary question, it would be, do retirees need alternatives beyond stocks and bonds to protect withdrawals when both fall together? Um, so I think the answer to this question, so this is education, not advice. That's me just hedging and giving a disclaimer. I hate disclaimers, but doing this type of ad hoc explanation it's worthwhile. Um, the question we have to ask ourselves is, do we actually need to change an investment allocation when we go into retirement? Is it actually too risky to support the retirement that we want to live? Um, to elaborate on that, we often, psychologically, this thing happens as we near retirement. We start to think more about risk because when you're an accumulator, you're mostly focused on saving, and we don't pay that much attention to market drawbacks. We can't control them, so we just focus on I spend less, I save more, I accumulate more. That's really the primary engine. As we get closer to retirement, our perspective changes. This is really a matter of perspective changing, in my experience, not so much people understanding their own risk levels, like what is actually risky within the portfolio. I'm going to explain that in a second. But the perspective change that happens is I get closer to retirement. And so I start paying more attention to risk and the problems that occur in early retirement or could occur in early retirement. And because I pay more attention, I therefore assume that I have some exposure to this risk factor because I've never done anything specific to prevent it. But never having done anything specific to prevent a potential bad outcome does not actually mean you are exposed to that bad outcome. Does that make sense? And so, like, as a way to frame that, an analogy, and then I'll come back and give you some actual data on our experience building hundreds of plans. An analogy for this would be going back to my earlier training exercise analogy. I've been running all my life. Now in retirement, I know I need to switch to weightlifting because of whatever. And I'm starting to worry that weightlifting is risky and therefore I need to take some preventative measures. The question is not whether weightlifting is risky, it's whether my body can handle the weightlifting. And I don't know that. But just because weightlifting might be different, new, and potentially risky doesn't mean my body can't handle it. So the best thing to do is to actually run an evaluation in controlled circumstances and get with a trainer maybe and do some actual weightlifting with very, very modest weights to see whether it actually is risky. It's a bit of learning and getting a diagnostic. The framing here is kind of the same for retirement risk. Just because you've never had a plan in place to manage risk, let's say, maybe, doesn't mean you're exposed to risk. And actually, coincidentally, much more often than you would expect, retirees come in and when we do their portfolio risk audit, we find that they don't really need to make changes to their portfolio, despite the fact that it's something like 8 out of 10 people say they think they need to make some risk reduction actions, take some risk reduction actions going into retirement because they feel their portfolio is tilted too high on the risk scale for a retirement portfolio. And then something like, so 8 out of 10 say that. And then something like 2 out of 10 actually really need to change their portfolio in a material way to make their risk level consistent with being able to support their guardrails in retirement. Now, again, not advice. This is just education and just me sharing some of my experience. It's purely anecdotal. But that framing is that perspective has really changed, that insight has really changed my perspective, which is that psychologically, I think what happens is we're just more attuned to risk. So we think we have more risk. The solution to that is to just understand risk better. It's to go in and not think of risk as a split between equities and bonds, because I've made videos on this. Different types of equities behave totally different and different types of bonds behave totally different. We have actually been dramatically underserved as a cohort, retirees, using asset allocations as a guiding principle for risk. It's a terrible measure of risk. Asset allocation tells you nothing about the underlying risk beneath your portfolio. Just to give us a simple illustrative example, we could have 2 retirees, each of them with a 60% stock, 40% bond portfolio. Retiree A over here has 60% of their stock in Tesla and 40% of their bonds in junk bonds or high yield, HYLD, some kind of it's a ticker for high yield bonds. And retiree B over here could have 60% of their stock in a Vanguard Value Index Fund, and 40%, the remaining 40%, which is bonds in 1-year treasuries, US treasuries. Those are totally different risk profiles, like unrelatable, but at the asset allocation level and in a financial planning software, they will look the same. And that is very, very misleading. And it often causes people to worry about risk in a way that they shouldn't, or probably is not beneficial, because the worry comes from the fact that asset allocation itself is not a transparent measure of risk. And so we kind of subconsciously know that. And so we start to worry about risk because we don't know how to transparently evaluate our own risk. A much better solution to this, rather than thinking about alternative investments or protection in that way, is to get a better understanding of risk. We don't need to seek a new variable to add into the complexity. Maybe we do, but we don't know that. What's better would be to go and get an education into risk measures and understand how our portfolio fits within those risk measures so that we can make more informed decisions. So hopefully that made sense. This is a decision-making framework, really more than an investment selection framework. And that would be my advice to anybody who's feeling that pressure going into retirement about not understanding their own risk. Real quick, let me show you the exact 3-pillar comprehensive retirement roadmap that takes retirees from uncertainty to peace of mind that less than 1% of retirees actually have in place. Now, I've built hundreds of these for retirees, and I can say with a high degree of confidence that these are the 3 pillars every retiree needs to have in place in order to have full confidence that they're not missing anything in their retirement plan. And I broke each of these down by the specific questions. You can see them here that each needs to be answered and the best way to answer them. Now, we've done this across pre-retirees, recent retirees, married couples, single retirees, $1 million portfolios, $10 million portfolios, all the above, and it works. And it's my gift to you today. It's absolutely free. It's in the first link in the description below this video. It's going to say free comprehensive retirement roadmap training. Just click the link, enter your info, and you'll get instant access, all for free.